looking into the 2026 outlook for multifamily and the way we are approaching multifamily investing in 2026 and really in the next year, 2027, and perhaps 2028 as well, because we don't see things changing drastically in the next 2 to 3 years. As we all know, markets are extremely uncertain and unpredictable right now. Multifamily as an asset class was a rock star of an asset class until 2023. The market softened, the returns were not quite there, and all that money that was chasing multifamily is now chasing other quick profits and other returns that are a little more quick. But in general, multifamily has always been a long-term play, and the 2022 through 2023 quick profits that people saw is not the usual. It's not the norm. So now, before we dive into multifamily outlook for 2026, let's also talk about some of the other investment classes that are available and how are they looking like, starting with the stock market. So if you look at the stock market, if you look at the chart, the stock market has gone up and down multiple times. Every gray line is basically either a major or somewhat of a recession, right? So stock market is not necessarily predictable. A lot of people think that stock market over the long run, S&P 500 over 40 years, 30 years will always be in the positive. But I would question that assumption. We have some more slides where we can actually show how S&P has performed during certain 30 and 40-year intervals. If you look at the stock market today, the price to earnings ratio is pretty high. It's at 28. And if you look at the rule of thumb by Warren Buffett, who probably is one of the best investors till date, if it's over 22.5, he usually doesn't like to buy because the stock market is overly inflated. And essentially, PE ratio is the market value per share divided by the earnings per share. So if you look at this S&P 500 today, it's definitely at an all-time high. So is it a good time to enter the market today and expose significant amount of your savings to the stock market today? I would definitely question that. Most of the market growth is really coming from one place, and that's CapEx investments in AI. And most of those investments are funded by petrodollars from the GCC countries. And if you look at today, what's happening in the GCC countries, they are war-torn. So if they have to make a choice where to put their investment or petrodollars to work, they're going to put those dollars to protect themselves first before they fund America's AI race. So will we continue to see the same type of investment in AI that we have seen in the last 2 years? That is questionable. And AI companies actually are not producing profit today. All of the valuations and investments are based on future profit and future growth. So that's a lot of speculation in the market today. Now, this chart is S&P 500 chart adjusted after inflation. So if you look at this chart from 1880 to 1920, that's 40 years. If you started at 1880 and ended in 1920, your return after inflation was zero. So imagine putting all of your wealth in a 401k fund in 1880 and you retired in 1920. You basically made nothing in terms of returns. Same thing happened again in 1955 through 1982 or so, over 25 years, 0% return after inflation. So you have to consider that possibility that you could actually have almost zero return by the time you retire in 20, 30, 40 years. And which is why I think it's important to diversify. Let's take a look at what's happening in private equity or private credit markets. I mean, you all may have seen these headlines about $265 billion in private credit meltdown. BlackRock, Blue Owl, they have all basically limited or frozen their withdrawals. And the exposure is huge, $3 trillion invested in private equity markets. And what private equity or private credit means is that if some businesses want to borrow money, but the risk levels are too high where the banks are not lending them money, they get this money from private credit at extremely high interest rates. So when those loans are being serviced and everything's going fine, private credit and private equity can return phenomenal returns, 18, 20% returns easily. But when things are not going well, that's when we have problems. So, which is what we are seeing now. Now, what about gold? We are seeing gold prices rallying. And what happens is when prices start to climb like crazy, that's where the money goes. It's the herd mentality where people just start to invest money in things that are just going up in value, and they continue to invest as the values peak, and we end up selling when the values drop, which is the opposite of obviously what we need to do. Be greedy when others are fearful, as Warren Buffett has said. But we are seeing the exact opposite again with gold. Does gold always retain value or grow in value? Does it always appreciate? Well, we can see here from 1980 to up to almost 2008, the value did not really go up. So, can it be a store of value? In some cases, yes, it can potentially be a store of value, but it's not an asset. It doesn't generate positive cash flow. The money is just going to sit there. So it's not truly an asset. So keeping a small portion of your portfolio in gold makes sense, but overexposure to gold does not really make sense either. And it's not portable either. So in a doomsday scenario, if you have tons of gold, you can't actually travel with gold if you have a gold bullion. And if you have gold ETFs, now technically you don't have gold, you have paper assets, right? You have derivatives. Now let's talk about Bitcoin. A lot of people have been investing in Bitcoin. Some people got into Bitcoin, lost some money. The first time there was a rally, 2019 to 2021. Some people started to go back into Bitcoin when Bitcoin almost crossed 126K. But it is a highly volatile and very speculative investment class. I wouldn't even call it an asset because, again, it doesn't cash flow, but it is very, very volatile and very speculative. So am I saying do not invest or put money in Bitcoin? No, but you need to be diligent about how much exposure you have to Bitcoin as well. And now Bitcoin has gone from 126K to about 67K in just a matter of few short months. And finally, what about saving cash? Just sitting on cash. We don't know what's happening in the market with the war, overly inflated stock market, job losses from AI. Maybe we should just sit on cash. But unfortunately, savers are the biggest losers, because if you sit on cash, you're losing about 3 to 4% every year due to inflation. So your purchasing power of every $100 or $1,000 you're saving is going down by 3 to 4% every year. So saving cash is also not much of an option. Sure, you can hang on to some liquidity and some cash as your rainy day fund, but keeping too much money in cash is also, honestly, a pretty stupid idea, because you're guaranteed to lose if you hang on to cash. There's more uncertainty, as I mentioned, coming from Iran war and the AI impact. We've been all reading about closing of the Strait of Hormuz, which has led to higher gas prices. When the energy prices go up, inflation follows. We are already seeing it at the pump, but that's only the first impact. We are going to see it throughout everything else, because petrochemicals and gas drives basically everything. The food that you put on your plate, it took gas to bring that food to your grocery store. So everything is over time going to go up. At the same time, the labor market is kind of weak. We actually lost 92,000 jobs in the month of February, while we were expecting to add 60,000 jobs. That's a 150,000 job delta. So that's not looking very good. And the feds have the most difficult job in the world. I mean, they have a dual mandate where they have to control inflation while protecting the labor market. And the only lever they have to pull or push is interest rates. So we have seen the interest rates steadily come down since the sudden peak by about 525 basis points in 2023, but they have not come down to COVID or pre-COVID levels. I mean, they are still fairly high. If you're looking at bank loans, they're at about 6 to 6.5%. Same thing with agency loans. And the prime typically is at about a little over 4. But at the same time, if you look at the 10-year treasury yield, which is the bond market, it's actually going up. And why is it going up? Because 10-year treasury yield is dependent on how much demand there is in the market for the US treasuries. And with the dollar losing a little bit of faith in the world market today, and China and Japan dumping the US dollar, the market is demanding a higher yield on 5 and 10-year treasuries. So now we are in a pretty precarious situation where the Feds cannot really reduce the interest rates because that will cause an uptick in inflation. And they cannot raise the interest rates because that will further weaken the labor market. So, which is why we do not foresee any changes in interest rate, any major changes in interest rates in 2026 and maybe even 2027. Okay. So, uncertainty is everywhere. That's the bottom line. So, where should we invest? So, if we look at what the ultra high net worth and high net worth individuals are doing, this is coming from a survey that was done by a community called Long Angle, which is a community of all high net worth individuals. They are investing their money in a broad range of asset classes. The biggest one being the stock market, 57%, private equity, real estate, alternative investment, which includes Bitcoin, etc., bonds, and then cash and liquid investments. So diversification is really the answer for most people. That is the correct answer, because that way you're not overly exposed to any one asset class. Now let's compare all of that with multifamily, including multifamily in 2026. So we saw all of those charts of the stock market, of gold prices, of Bitcoin prices, and we saw how up and down they were all over the place, which is just basically making a statement about how volatile all of these other asset classes are. Now, in comparison, look at the cap rates for multifamily, which is really the only market-dependent factor that drives pricing for multifamily real estate. And sure, you do see ups and downs, but it is relatively smooth, even, and relatively flat. So it's not changing on a day-to-day or month-to-month basis. And that exactly is what we love about multifamily and in general real estate or commercial real estate, is because you have a long-term horizon, you see what's coming, and you can make business plans based on what's coming. So if you look at the cap rates, they peaked in 2008. So at a higher cap rate is actually a good time to buy because that's when you can buy properties at a discount. The cap rates were compressing slowly and steadily until pretty much 2022, which is why everyone was buying properties, selling them, buying them, selling them, and making a huge profit. Everyone was looking like a rock star. Multifamily was attracting capital like just anything, right? Money was just chasing multifamily deals. But then interest rates went up, cap rates expanded, and now we can see in 2023 and early 2024, they actually peaked, right? And that was kind of this small recession for multifamily. I mean, we are still not in a depression, but we are definitely in a recession. Cap rate expansion happened, price correction happened, the prices went down. So if you bought multifamily in 2021, and if you're trying to sell it in 2023, well, boy, oh boy, you're in a tough spot, right? Because even if you did all your best to increase that NOI, the cap rates are hurting you. Is that the end of the world? For some, it is. But if you're a good operator, and if you can hang on to that asset, if the asset is still cash flow positive, you can ride this wave, hang on to that asset, and wait until the recovery continues to happen and sell the asset when the cap rates come down. Will the cap rates come back down to COVID levels? Maybe not. But if you have done a good job as an operator, increase the NOI well enough, even if your cap rates have gone up slightly, you can still have very much a profitable exit. And all sources, including all the economists in real estate, like John Chang from Marcus Millichap, Jay Parsons, Bob Fraser, all the big names, they all agree that we are already in a recovery phase. However, everyone also agrees that it's going to be a slow and painful recovery. So people who were so used to seeing quick profits, well, it's disappointing news. The time to make quick profits in multifamily is gone. But that does not mean that there are no longer profits in multifamily. So if you are looking at long-term horizons, 5, 7, 10-year plans, and if you know how to operate, there are still healthy profits in multifamily. At the same time, the risk levels, as we've all seen, clearly are a lot lower as compared to some of the speculative investments that have gone all over the place. Let's look at the supply and demand equation. So the supply and demand equation is still very much favorable, right? There's still housing shortage overall in the US. In some markets, there is oversupply, but even that oversupply is now being absorbed. So even that is a positive news. So all in all, if we have to sum this up in just a few key bullet points, our take on multifamily in 2026 is to focus on value add B class for forced appreciation. Stay away from stabilized properties with no value add potential, especially if they don't provide strong cash flow day one. So if you find a great turnkey property, but it cash flows 7 to 8%, and it's in a great location where you will get some market appreciation because of just how good the location is, sure, you can go for it. But other than that, if the property doesn't provide strong cash flow, stay away from that property unless it has some value add potential. Stay away from C and D class properties because they just add another layer of risk. And as the affordability crisis continues to worsen, these are the areas that are going to be the worst hit. C class assets typically have more maintenance and more repair bills, more deferred maintenance. So it's a good idea to stay away from those right now because there's not a whole lot going in the market that's going to help you overcome some of the mistakes that you might make with C and D locations. 2026 is going to present pretty good investment opportunities and buying opportunities only for the strong operators. We are already seeing a lot of the operators are not even operating anymore. People who didn't know how to run these properties and actually put in the blood, sweat, and tears to improve these properties are already out of business. But if you are a strong operator, there are great opportunities out there. There are many failed deals, failed value adds, people who did lipstick on a pig renovations, hoping that they will get great value for their property. All of those deals are failing, especially those deals that were purchased on bridge debt, which is floating interest rate debt, right? So as the rates went up, these properties are now in trouble. Conservative underwriting is always important, but it's more important now more than ever. So rent growth, I've seen underwriting models with 5, 6, 7, 8% rent growth, but I think sticking to a more conservative 2 to 3% and maybe even flat rent growth or zero rent growth for the first couple of years is the way to go. Cap rate compression, I would not assume cap rate compression, which means cap rates going down, at least for the next couple of years. I would assume cap rate expansion. And in general, that assumption is always a good rule of thumb. If you're buying at 6 cap, always assume at least 50 basis points or 0.5% increase in the cap rates by the time you exit. So exit cap rate of 6.5 at the very minimum. Vacancy rates, we have to be very careful with those. The vacancy has ticked up in the recent years. So having a vacancy rate of 8 to 10% at the very minimal is conservative. If you have more vacancy rates built in, it's even better. Expense increases, insurance taxes are going up pretty fast. So you got to be cognizant of that as well. The era of flipping multifamily properties with lipstick on a peg renovations definitely is over. So the long-term outlook, 5 to 7 years, like I said, is very strong. But short-term outlook, honestly, is weak to mediocre at best. So if you're looking to flip multifamily and make quick money by buying a multifamily and selling it in 2 years, tough luck. That's unfortunately not going to happen because we don't see the interest rates moving. We don't see the cap rates moving significantly. So unless you are able to really add tremendous value in your property in 2 years and increase the NOI, which can happen through a very heavy value add deal, that's really not going to happen. So right now, if you're investing in multifamily, you have to have a long-term outlook. And although human psychology dictates otherwise, we have to keep in mind, buy low, sell high. The prices are finally coming to reality. We are seeing at least fair market prices for multifamily assets now. So, which is why I think it's a great time to buy. The best time to buy is near the bottom and early in the recovery cycle, which is exactly where we are at. So all in all, I think it's a great time to buy right assets in the right locations and at the right price. So again, we don't think it's a great time to buy, period. It comes with a caveat. You have to buy the right assets, in good locations and at the right price. Overpaying assets in any market cycle can be disastrous. So my question to you is, what would you rather invest in? AI stocks that don't produce profits today and are purely funded by, investments from primarily the GCC countries, a lot of speculative investments, or an asset class that has been proven and has, stood the test of time for 5+ decades and serves a basic human need of shelter. I think for me,